to use and I have to change some of the slides because I was just reviewing them before I got on. I want tonight's putting it all together, and I want to focus on a loose and a tight definition of a covered combo trade. The loose definition being, of course, constantly trading the same stock. And the tight definition is the specific selling in the money put shares, accept the shares, selling in the money call over and over again. And from that, there are 3 other trades discussed. And
say that again about the combination, because the combination, the way I understand it, is if you own the stock and sell a call, you would also could sell a put against that, or sell a put on it at the same time.
I'm talking about what you and I discussed before we even did the coaching program, is what you were doing with Verizon.
Right. Yeah.
And that's what I'm talking about tonight.
Okay. What I'm saying is that what I do is I sell calls on Verizon, and then I also sell puts on Verizon at the same time.
But then you have a double-sized position, correct?
Not sure. I might do half of it in puts.
Yeah, exactly. This is a variation, and we can fix it. But the way the examples are set up is to keep it straightforward, where you're trying to get money and you're trying to get cash, and you're trying to generate a lower cost of buying the shares by selling a put, preferably a weekly. You get put the shares, you're getting it really at a lower price because of the cash you've collected, and then but you'll see when you go through the program that's sort of an umbrella approach, because we want to talk about 4 different tactics today and how you can go back and forth depending upon how you work one stock. So let's go ahead. Here's the agenda for tonight's session, and we had a lot of stocks to cover, so I'm going to actually cover them fairly quickly. We've had very good results. What do you want to ask tonight?
Well, it's hard to do the trades in a survey because it's all.
Yeah, I agree.
It's all. What do you say? It's no way to do the survey that way. So it's.
Do you want to do a survey now, or just let it go?
Well, let me see. Let me just go through your presentation, and I'll think about it.
Okay. Last week's trades, there were a bunch. These were from the week before, obviously, and in case people hadn't done the good until canceled orders, and there were the live trades, there were the trade recommendations. I'm going to go through these pretty quickly, but they're all, besides being all puts, they were representative of different things. The Illumina put was a very, very profitable trade, and it was one that would have gone off automatically on a good until canceled order a few days before we actually closed the position. And Kim and I put out an alert on Friday in case people hadn't used a good until canceled order, or we think we did on Thursday, excuse me, to close the position and just pocket the money. And those are the numbers down there. We made a lot of money. And one of the things you'll see in all the results, Dave and Kim, is that they're well above that 25 to 35% range. Verizon was the same thing. We sold an in-the-money put. Assuming the stock was going to go up, we had the good until canceled, and I'm going fast, obviously, here tonight, right now. And the whole point of this, you can sell an in-the-money put if you believe in the stock. The stock quickly climbed above 48, and so forth and so on, and we did, so you can sell an in-the-money put if you really believe in the stock, and you can take a look. This really boosts the annualized return on a stock that doesn't necessarily have a lot of volatility, which is Verizon. On Transocean, we needed to roll this. Transocean moved in the opposite direction of where we were hoping. But again, because of when we sold it and how we sold it, we were fairly aggressive on this trade. We had a lot of cash to work with at 75 cents or $75 a contract. And we've rolled it. We've rolled it into a position for June, but that doesn't mean we can't get out this week. I put it into June to generate extra cash. And it was a pretty volatile period of time in the stock at the end of last week, and there was extra premium available, so it was time to grab it. And we did grab that premium, and we're now in absolutely great shape to close the position as early as we want to, as long as we get and we hit our income goals. SanDisk we let expire. It was kind of up and down on Friday, and it looked like it was going to come back to that $71 price point. That was very clear from the beginning, was very, very strong support on an interim basis for the shares. It closed above 71, so we just sort of watched it evaporate. And I calculated this as a 2-week trade. If you had closed it early when we had the opportunity to do so on Monday, you might have even had a higher sort of rate of return. We could have made well, roughly the same rate of return because we would have closed it at about a 65 cents a gain. So it shows you can close early and get a good gain, but you can also, if you're going to ride it out, you can get that good gain as well, depending upon what would have happened. And of course, the return is up there in the 35% range. Grubhub was a one-off. It's not one of our bullpen stocks. It's not something because of the whole issue of it being an IPO. It's very volatile, and we're looking at the stock. The lockup ending in October. You have to keep a close eye on this and do everything short term. The flip side is, for those reasons, it's very volatile, and we made a really, really wonderful return on the shares at a 58% annualized return for selling an old-fashioned put. There was nothing fancy or complicated. This would have been if it had been a more conservative stock, this would have been an options income blueprint recommendation. Tesoro, and this is where the presentation tonight gets into real learning. We sold the June 55. Now, if you remember, and I don't want to have to pull up the screens from last, but I can. I can call up the calculator. I chose not to sell in May because of the concentration of positions we had in May. The May calls would have returned in the 40s. The May puts would have returned in the 40s. The May-June has a potential return of 37% if we held it through the third week of June. The stock moved very strongly since the time we put the position on. We can buy it back now. That should not be 170. Yeah, that should be 170. That, even though we're giving up theoretically three-quarters of the cash that we generated, we're doing this in less than a week. We're getting all our capital back to use for another trade. We would have a $65 profit per contract. That's a 59% annualized gain. That's more than 1% in a handful of days. We put this position on last Wednesday. So this is the kind of decision making you make, especially when you're trading in and out of a share, a stock that you know and you know well. You know you're going to come back to it. The question is, you really want to hang on and tie up your capital. Hello? Do you want to hold on to your capital? And my recommendation would be is if the stock holds tomorrow morning, we get out. That if we can have this kind of an annualized gain, we close the position tomorrow, and if necessary, we'll send out an alert reminding you to do so. I'm going to put a chart up for Tesoro.
Okay, back up. Okay, you're going to put a chart up on Tesoro.
Yeah, I'm going to put a chart up on Tesoro.
And you're thinking that it may not hold, or you're thinking...
No, I'm thinking that why tie up your capital for almost another month? That if we can get this kind of a gain from Tesoro, and I'm trying, and I said I'm going fast, maybe I'm going too fast. I'm trying to show that if you own a share of bullpen stock and you like the stock and you're going in and out of it, grab the gain while you can. You can come back to it tomorrow. At the weekly, you can buy the shares and sell the call. When you have that much money on the table in a potential profit, especially since these people aren't worried about commissions, or shouldn't be, just close the trade. You know, it's just you're freeing up your money after being in the market for 3.5 days. And that's sort of the teaching moment here, is that just because you planned on something for June and it's a stock you know, it doesn't mean you can't seize on an opportunity. The original potential annualized gain was 37%. It's now, we have 59. So this is actually, assuming you put your capital to work again sometime this week, it's a better trade.
How many days? When did we get this?
We put it on last Wednesday.
Wednesday, okay.
Hey, Michael.
Oh, no, we put that on Tuesday because we would have, Monday night was the...
Live trading session was last Wednesday.
Was Thursday.
Then we put it on Thursday. This is a live trade. This was not one of the stocks.
Oh, this was Wednesday. My fault. You're right. Yeah, okay, gotcha.
Yeah, so this is one of the live trades. Yes, Kim?
What I was going to say with the Tesoro example, where you have a specific lesson, like you're kind of teaching them on this, do you think there's a benefit to, in a slide before this, say, here's an example of, and like state what you're trying to show them with this example?
Well, I'd rather verbalize it, but I can put, what I can do is I'd rather, that's a good point, is I've had a lot of coffee today. Tesoro and Sierra Wireless are the same exact things, that we can close them out very early for spectacular gains. And what I do is I have a wrap-up slide. What I'll do is a separate wrap-up slide for the two of those about the merits of closing early. And that, I think, would go to your point.
Okay. Good.
And I'll add that in. I'll show you where I'll put it on in a minute. So that's Tesoro, and then we go to Sierra Wireless, and we're in the same exact position. We can get 100% annualized gain if we closed it before the close today. The stock popped today. It was up $1. And not necessarily any news. And you can buy back the put for 50 tomorrow if it continues to run. And it'll be the same wrap with Tesoro. We'll put out an alert. I think we should close it. And then here, Kim, in the next slide, well, the next slide's a chart. Rather than this summary chart, I'll put a summary of those two, and I'll design a chart that talks about the value. Maybe I'll even put in 2 charts, why you close early. And that's what I'm going to put the title of the chart. Why you close early.
Yeah, good.
No, I agree. I agree. Good teaching, Mo.
That's a very good point, Kim. Thank you. You know, sometimes I get too close to this. I always get too close to it, actually. And the other teaching point that I tried to emphasize during the live trading session was we had very nice potential made positions, but we already had 6 positions out. And you don't want to, and this sets the stage for next week, which is the whole thing about portfolio allocation and position sizing, but you don't want to concentrate too much. But that doesn't mean you're in the position for 3 or 4 weeks. It shows the value if you catch something at the right time. So the 2 slides I'm going to add because of Ken's comment, plus this, work together very well. So here's the heart of the coaching part of it, putting it together. Oh, wait a minute, that's the wrong chart. It shouldn't say what start with a trend. That, excuse me, this should say the umbrella approach. That header should say the umbrella of working with a bullpen stock or something like that. But the blocks are correct, but the title is wrong. I have to change slide 16.
So what would the title be there then?
It's I'm managing a bullpen stock.
Okay.
You have to excuse me. They put polyurethane on some floors in my house, and I can't breathe. Anybody want to breathe for me?
Open the windows.
Oh, I've opened all the windows, Dave. Thank you. I would have never thought of that. That's why you're the problem.
Well, we don't open our windows here because we got people with allergies, so we don't always do that.
Well, it's funny. You know, that's what's getting me. In fact, again, I'm going way too fast. I've been up for a while. What's probably getting me now is the pollen coming in from my trees because we always seal up the house for the same reason, but I had to open them because of the polyurethane. So what I want to show you today, and this is where I'll slow down, is let's say you have a stock that you like. It could be one of mine. It could be one of yours. And let's say it's what I've been calling a bullpen stock, something that you're going to move in and out of for a very extended period of time because you really like the company, you like the stock, you like the fundamentals, you like the way everything has been moving over the short and hopefully it's going to be the long term. I put here on the second leg up something called the covered combo trade, which I've alluded to. I'm not getting this, obviously. Somebody's home. Answer the phone.
Call from 4847
There we go. And I want you to understand that the covered combo trade is not just a specific type of trade. The covered combo trade is also something that almost serves as an umbrella approach towards how you apply tactics to a specific stock. And the reason I'm repeating myself here, I want to go through these steps. I've always presented this sort of step chart going towards a specific trade as a way just to visualize things. But tonight, I want you to look at, you have a potential for a covered combo trade, which means moving in and out in an organized, logical, sequential way to extract the most amount of money from the movement of a stock, sideways or upward. That's a covered combo trade. We're going to go through a specific one in a moment. There are variations underneath that, and there are things you can do even if you only want to be in for a couple of months. The logical covered combo trade is what we have called in the past a double dividend trade, which means you're getting in and out of a dividend stock, and you're being very aware that some dividend stocks sell off after they go ex-dividend, meaning if you sell a call at the appropriate time, at the appropriate strike, before it goes ex-dividend, then you can anticipate that the value of the stock and the value of the call will go down and you can buy it back, and you're adding to the amount of premium that you're going to get from owning the shares and collecting the dividend. We opened here in part to get your attention and in part to show you that there are ways to own shares and generate cash almost on a day trading basis with a daily cash call. This is a sound effect. We should do this in our training video. Just do all these sound effects. Lawnmower, dog, telephone would be great.
Sorry.
The daily cash call trade goes back to, we alluded to it boot camp session. We alluded to it and spoke specifically about it actually in session 1. The daily cash call trade would be you own a covered combo stock, you don't necessarily have a position out, or you've chosen just to trade it on a daily basis because it's either skyrocketing, it's going up fast, and you don't want to be called out of the stock, so you're being extra careful. But there's ways to do this where you can benefit from the movement in the shares going up, flattens out, goes sideways, the temporary downturn. You can collect some money. For example, we were doing Gilead in early on in our coaching program, and when it hit 80, it slowed down for a while. It was the perfect time to do a daily cash call trade because it was a little volatile. There was some extra premium there, and you could grab it. And then there's something that we've alluded to, the weekend cash trade, which is just a 2 to 3 to 4 hour trade on Friday afternoons. And you may do this on purpose, again, because you're leery of being called out of a stock or you're leery of being put shares. You can do that with a call. You can do it with a put. These are all variations of selling a covered call or selling a put. But they come under the umbrella of moving in and out of a stock that you have in your proverbial bullpen. The covered combo trade, a specific trade, is when you do it in a very logical way and you're doing it with specific dates in mind if there's a dividend. And all of these can fit into that pattern, or you can do all of these because you like these tactics, independent of whether you're going to move in and out of a stock for 2 years. So tonight's the night where we're tying together, you've made the stock pick, what can you actually do with it to keep on moving in and out and in and out. Now another way to look at this is you have the stock, and it's going directly into this covered combo approach, either specifically that in and out trade that's highly defined, or just an umbrella way of looking at this. But what you do is you can look at the different kinds of tactics and go, which one is going to get me to my income goals? And if you take a look at what I just said we probably do tomorrow morning, which is get out of the 2 trades we put on that are performing much better rather than wait till June. Well, that annualized achievement that we have is well beyond, let's say, the income goal of 25 or 35%, is much better than that, and we're freeing up our capital. So we did that trade. It was a superior trade. It doesn't mean we're not going to come back to the stock. It doesn't mean we're not going to use a different tactic. It doesn't mean we're not going to do a covered combo trade. Think of it, the covered combo here, almost as a metaphor for getting in and out, in and out, in and out with the same name, or with the same 2 or 3 names, or 5 names, or whatever is in your own bullpen. But it has to be brought back to income goals at the individual tactic, not just the whole flow, but each tactic should meet the criteria that you have in your position calculator. So you start inside your bullpen. I mean, it makes common sense, but I do use the word start very, very carefully, because your bullpen is occasionally not going to provide the best fit with each of these tactics. And as you saw with Grubhub, there are times where you're following a stock, it's not a core holding you're going to really go in and out of because for whatever reason in the real world, but you still want to trade it, and you may want to trade it in and out over a period of weeks rather than a period of quarters and years. So a lot of these tactics can apply to even something short term. And remember, you have to match the stock to the tactic and to the events in the real world. You can't necessarily, let me go back, you can't necessarily do all 4 of these, especially weekend cash, with all the stocks that might be in my bullpen or your bullpen. Like Verizon, for example, weekend cash trade is probably going to be a very, very weak trade for you. It's just not volatile enough. It would be a great trade on something like Seadrill, which is quite volatile, or even Apple, or something like that. So using the covered combo in a narrow sense here, you take a look and you say, I like a stock. And we're going to get to a specific example in a moment, but let's take a look at the logic flow. The first thing you want to do is you have to set up your timing and, of course, your capital allocation and so forth and so on. And you're looking at events. And the 2 big events that you can predict are earnings and the ex-dividend date. And some companies like Apple might have a developers conference or a product announcement, but the real events for most companies are earnings and ex-div dates. So the typical flow, if the numbers work, is you sell into the money put, you accept the shares. So selling in the money put, you're generating cash. You're accepting the shares. If you've done the put and it worked out the way Verizon did, then you're accepting shares at a lower price than the put if you've read your stock properly and you picked the right put. But you may be accepting shares that are more expensive because of the strike price than they are in the market. You turn around and you sell the call. and you do it over and over and over again. And you sell the call and you do it again, and there's no room in this chart, but there's a variation here. You can sell the call knowing you're going to be called out, or you can sell the call not wanting to be called out, depending on the trajectory of the stock, of how fast you think it's moving. This simpler example is you want to get some extra premium, some extra cash in your pocket by selling an in-the-money put. You're accepting the shares, and then you sell the call. So on both ends of that strike price, you're making money. You're making a profit. You're generating cash. And you can do it over and over and over again. If you clearly want to own, you clearly want to pursue this strategy, you might even want to sell the in-the-money call, get called out, and do it over and over again. If you really think the stock is going to go from 80 to 140 in a year or two, then you may not want to sell a call that's in the money. You're going to want to sell a call that's out of the money. You're going to manage it more tightly. It reduces the risk of being called out and how you have to manage that position and so forth and so on. Now, a variation of this, which is sort of a subset and adds a wrinkle in terms of dates, is the double dividend trade. And the example I'm going to give you is which is the next slide, is a double dividend stock. So the ex-dividend date is primary here, and this is a stock you want to own. You want to acquire it. The best way to do it, if the numbers work, is to sell that in the money put. You accept the shares. You sell a call that expires after the ex-dividend date. And when you do the math, and we did this actually in the boot camp, you have two. When I showed you the position calculator, when you sell the call post ex-dividend date, there of course is always the possibility that you will be called out because the stock rises in anticipation of the ex-dividend date. So you have to do it within a 2 to 3 week period before the ex-dividend date affects the stock. So you sell the call post that expires in the ex-dividend date, and a couple of things are going to happen afterwards. You're going to collect the money for the put, collect the money for the call, and if you still own it, you're going to collect the money for the print from the dividend, and then you're going to do it all over again. And you're going to do it over again. This trade works at least 4 times a year, and sometimes, depending upon the movement in the market, it works 6 times a year. We're going to do this procedural. Now, let me do a segue here. I just finished a cheat sheet calculator for this kind of movement in and out around a dividend. I was anticipating adding it to the work we were doing, the double dividend script. I don't know whether to do some screen captures and put it in, or just say that we have a spreadsheet that you can use.
If you've got it, I would use it.
Okay, then I'll do the screen. So what I'm going to do in this example, I'll show you where I put it in. I'm going to put some screen captures in, and to show you exactly, it's a 6-step approach. In fact, let me call up the spreadsheet now, if I may.
Hey, Michael?
Yeah.
Before we get too far away, if you go, when you started talking about the double dividend in the previous slide, you said it was a wrinkle for the combo trade, but I'm not.
I said it was a subset. It was a subset.
Okay.
Yeah.
Okay, I guess I misunderstood. I thought you said it causes a wrinkle. And
oh no. And I'll be more careful with my language, since obviously I talk fast, and I'm talking very fast right now, faster than I will tonight. Let me call up the let me go to the screen and show you what I've developed. See if it's clear enough. Are you seeing a spreadsheet?
Yes.
Okay. Yep. So if you walk through the Seadrill trade, your step 1 is to sell the puts, and these were prices as about 1 o'clock this afternoon. The step 2 would be working on the assumption that the stock continues to go up. The stock, you're 2 cents in the money here, okay? But I wanted to keep it simple. I didn't want to put a $35 in or whatever. I can't. I'll take a look at the numbers tonight after the close, because these are going to be the recommendations in addition to the examples. I don't want to do separate ones anymore. So step 2 is you're going to accept the shares. Step 3 is you're going to sell the calls, and you have some choices. Step 4 is you collect the dividend, and step 5 you have you calculate your cash if you receive the dividend, and this is your cash that you've received based on these combinations. If you sold the May 35.50, turned around and sold the June 36, you sold the May 36 and sold the June 36. There's 4 possible combinations, and that's why I kept it simple. You can see. You have 2 possibilities of selling the put, 2 for the call, because I had to get down here and I had to keep it manageable. And here's the different potential rates of return, including the dividend. Now, if you get called out, one of these things these numbers prove is that this is still an excellent trade, except for this, because the 37 is pretty much it's $1.50 out of the money. So this is real teaching with numbers here, in that even if the dividend doesn't come your way, this is a good trade. And excuse me. So I wanted to show here that the double dividend is really a super trade. And
can I back up?
Sure.
So just because I'm a play student, that I've got a question.
No, you play student better than anybody, so please.
Okay, so on step one, I sell the May 4 30. I don't know which put it is.
Or the strike 35.50 or the $36 put.
Okay, let's say the sucker runs like crazy. It runs to 37, and I don't get put between now and then.
Then you revisit the trade for the next weekly.
Okay, so but what you don't have in here, maybe this is what I'm missing, isn't there a dividend date coming up?
Yeah, the ex-dividend date is June 5. Okay, I'll type it in.
I don't know if you need to type it, but it may need, I don't know, some kind of overlay.
No, I need to put it in. It's a very good catch. I mean, it would be confusing without my mentioning when the date is. It may have been in the slide. I think it's in the PowerPoint slide, but I'll put it on this sheet as well.
Just because if
No, it's a good idea.
And then, but my question then as a student is, okay, now June 5th, is it going to be before June? There's a May week 5, isn't there?
It's a May week 5, yes.
Okay, so it's going to be before I have another chance to get put the May week 5. Same question. It runs again.
Well, then you can buy the shares and you can do a simple call calculation, and I can do that live tonight. I can do the call calculation tonight live.
Well, the real question is, if I'm not in Seadrill, if I'm in Seadrill, it's not a big deal. I can sell calls and collecting the cash as I'm going along. But if the stock in theory is running faster, closer to the ex-div date, is it better to buy the shares? Is there a timing element to buying the shares early to make sure I'm there for the dividend versus selling puts?
If you really want to be there for the dividend, you simply buy the shares and sell the calls, and you forego the premium from the puts. If that's one view. The bipolar view is if you really think it's going to run, then you sell a fairly deep in the money put. You don't sell a 36, you sell a 36.50 or 37. You collect a lot more premium, and you've averaged down, and it's a gigantic win of a trade. But the reason I avoided that, for the simplicity of there are 4 combinations, is I don't necessarily think Seadrill's got a lot. This is a real trade. Seadrill has enormous amounts of resistance in the $35 to $36 range.
Okay.
And that's the basic reason I stuck. But those are good questions, and I've made notes to address them.
Because only from experiences I tried to do Seadrill the last time by selling puts.
It moves. It really moves.
And it moved up right before the dividend. I never got in.
Yeah.
And then I went and bought it, and then it dropped, and I didn't get out fast. Or actually, take it back. I bought it and sold a call, and it moved past the call, and I got called out right before the ex-dividend.
Well, it means you need to manage the position more tightly.
I know. But I'm just saying
Well, the question is, should I add alternative steps to the spreadsheet about...
No, I would highlight too, is it worth doing, is there another...
The next example is Verizon.
Okay, never mind. If you're going to do Verizon, that's fine. That's my point, is you got a more steady one like Verizon.
Oh, yeah. That's why I put 2 of them in, because here's the wrinkle. One of the reasons the premiums are so high in Seadrill is earnings come out May 28th. Okay. And I'm using it as a teaching example, is you're not just going after the ex-dividend date. Don't get seduced by the numbers. You have to worry about real-world events.
Okay.
So, and by the way, here it is on the slide. The ex-dividend date is June 5. Can you see the PowerPoint?
Mm-hmm.
Okay, so this is the flow that I go to the calculator, and I'll do screen captures and tell them it'll be on the website.
Should you put it? I don't know whether it's in that chart. Should you put the earnings date too?
I wanted to surprise them, but maybe I should.
Okay, well that's okay. Then add it. That's surprising.
No, I wanted to surprise them because I wanted to go to the numbers. I said, look at these great numbers, and I go, wait a minute, folks, go check the NASDAQ, and the NASDAQ site has the earnings date, and the earnings date for Seadrill is May 28th. And I wanted to say, you can't forget about real world events, and that was one of the reasons it's not on the slides. So there's Seadrill, and I said in Seadrill is also the ideal stock for your bullpen. Getting back to the presentation, because Seadrill is quite volatile, and it will be increasingly volatile before earnings, and it'll be increasingly volatile before the ex-div date, making it, if you own the shares, this is a strategy, if you own the shares, great for a daily cash call. Here's an example. If you bought the shares today at $35.54, which is midday today, and you sold a $40 put, a $40 call, you could have bought it back, and you could have made 35 cents in one day. In a 24-hour period, if the stock retraces, because 35 to 30, I have to make some notes to myself to make. That's not a clear chart. I have to clarify chart 23. It's a little confusing, but the point was that this double dividend stock is also an excellent daily cash call stock. And then the point here is it's also very good for a weekend cash trade because of its volatility. You can generate up to a 10% annualized return by selling calls on this at 1 or 2 o'clock in the afternoon on a Friday. And that's what I mean by multiple tactics off of one company you think is going to grow and do very, 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 very well. The other value of a weekend cash trade is you may be following Seadrill, you may not own the shares at the time of the Friday. That kind of volatility will also give you the opportunity to sell a put that 99 out of 100 times will expire worthless. And because it's one of your bullpen stocks, if for some chance you get put the shares on a Friday after a weekend cash trade, you would turn around and sell calls on Monday. So I'm going to go over this. I haven't finished this chart yet on a couple of bullet points about Seadrill. There's the chart. It's the same thing with Verizon. And I'm not going to go through all those blocks again with Verizon, but Verizon, to your point, Dave, is being positioned as a much more conservative way to do this, and I'll have that spreadsheet with the Verizon numbers. And I'll talk about that this is a stock that is much simpler to manage. There's a lower return. There's no earnings on the horizon. This is about ex-dividend. And 2 out of 4 quarters, the stock does not move abruptly after it goes ex-dividend. Sometimes it does, and sometimes it doesn't. There's not a level of predictability in the market about exactly when it was, and the chart will show. I got to put a year-long chart too if I'm going to prove that point. So this is a variation because as a covered combo, Verizon is almost an ideal stock. It has weeklies, it has monthlies, it has a dividend, and while it has some volatility, it is an easier stock to manage and an easier set of position to manage than Seadrill because there's not a lot of difficulty around earnings dates. Excuse me. There's not as degree of difficulty around earnings dates or around ex-dividend dates, and you can turn their 5% dividend into a 20% annual yield, maybe 25% and hit your income goals. And then if you account for that the stock is trading at 48 and change, and it was at 55, if you throw in the potential appreciation of Verizon if you own the shares, it's a 35% gainer in the coming 12 months, which is the reason I'm talking about it tonight. So I'm going to juxtapose it, and I just decided I'm going to add a chart comparing the two. Comparing the two positions. But these are the two positions I'm recommending to put on. And it's really whether people want to expose themselves. And then there's Blackstone. And Blackstone is the middle ground. What I mean I'm going to recommend, we're going to see how they all open tomorrow. Blackstone is the middle ground between Seadrill and Verizon. Blackstone has developed a very hairy ceiling at $30 a share. The stock's worth in the low 40s. It has an erratic dividend. And professional investors, sophisticated investors know that it has an erratic dividend. It can be $1 one quarter and 20 cents another because essentially it's a giant private equity firm that's publicly held. So depending upon what assets they liquidate in a given quarter, the dividend will vary greatly. And it's not a REIT, so it's not giving out 90% of its earnings. It's retaining a lot of earnings, plus it's a money management firm, plus it's the largest shareholder in Hilton, plus it's the largest shareholder in La Quinta, both of which went public. So there's a lot going on with Blackstone, and I'm going to use Blackstone as an example of doing this. And I want to present people with 3 different choices as they try to learn a little bit and go through it. And again, I'll put together a calculator on the different potential Blackstone outcomes. And to your point, Kim, I'll do a wrap up. I mean, Dave, I'll do one where if you just own it, and I think I'll do it with Verizon. We're not going to do it in the money put. This will just be no, I'll do that with Blackstone. Well, Blackstone will be something we're not going to sell put. We're just going to own the shares and see how we sell calls and do the dividend and simplify towards the end. I'll do it with either Blackstone or Verizon because I don't want to make three complex in and outs with everybody. So you're going to have three that look like the Seadrill position, and then the question wrapping up is which stock. And ladies and gentlemen, this goes to your preferences. The preferences are, of course, you start with your income goals. You're trying to do 25% a year. You're going to be very aggressive, try to do 35% a year. Do you have a bias towards really renting? Like you prefer to sell puts 50 weeks a year than own shares? Some people are like that. That comes into the equation. How much capital do you have available for an efficient position? Meaning if you're going to own these, you want to own a certain number of shares so you can sell calls, you can sell blocks of calls, you can reduce any impact potential that the commissions would have, and you can generate large chunks of cash, obviously, from the capital. And you have to be aware of events. Now, Seadrill has an earnings event. Verizon and Blackstone do not. And in the bullet point charts, I'll put their ex-dividend dates up. You have to take into account doing this because we're not just talking about double dividend trades here. Blackstone has a small dividend, Verizon has a medium-sized dividend, Seadrill has a large one. And the bottom line is these are three very, very good, what we would call covered combo stocks. You can do all four trades against these shares. You're going to make the most money if the stock keeps moving with Seadrill. You're going to make the least amount of capital return with Verizon. It's going to be the most straightforward to manage, and Blackstone is in the middle. Now, the other value of Verizon and Blackstone is they both have weeklies. Seadrill, I don't know, I can't remember if Seadrill does or not. I have to take a look. But I'm going to walk through. If they have them, they're very lightly traded, which is why I was thinking of saying it's just monthlies. So I'm going to walk through bringing them back to what supposedly they've learned. You have to do all of this with your math, and the math has to work on the assumption you're going to be following these stocks for a while. This is not a one-time trade, and you're going to be moving in and out. And you know, I put in, ladies and gentlemen, I put in the Seadrill example. The numbers are fabulous. Aha! There's an earnings announcement coming up. I put in Verizon, and by the way, I own all three of these stocks. Verizon I put in there because you may not get the rates of return. It's a more straightforward position to manage, and it sometimes trades down after a dividend. Sometimes it trades up. Sometimes it trades flat. In Blackstone, the dividends are episodic. You don't really know what the dividend's going to be, except over the course of a year or 18 months. You know they're going to be very good. So this is a different set of mixes and matches, and of course send me an email if you have any questions. But tomorrow morning I will put out an alert. We're going to have a busy day tomorrow because we're also going to do our live trading session tomorrow, where I'm going to put out an alert and we're going to talk about a little bit at length about specific recommendations for each three of these stocks if a recommendation is valid based on market conditions. And I hadn't finished this chart. I may even kill it. This chart is a restatement of what I just said, and it's probably not necessary. I'll just take it off. But I was going to say it's about your biases of short-term versus long-term. They're not mutually exclusive, but I think I'll just keep it up here and kill that chart. So to wrap up, and next week I'll take a look, and the live trading session I want to do tomorrow.
Okay, so you want to do the live trading tomorrow?
I think we should do it tomorrow, yeah.
Okay. And so these trades you're going to put out tonight, do we just update them in the live trading, or do you want to send something out?
Oh, what do you think? That might be fun. Make these the live trades tomorrow, put the two together?
Yeah, I mean, you could give them the preview tonight, say then we'll confirm them at noon. I mean,
yes, make these three because there are three of them instead of two.
Okay.
Let's make this the live trading session tomorrow. Very good idea. Excellent idea. Glad I thought of it. They can do their homework, and this will be the live trading session for tomorrow. We'll pull the trigger on these. One of these, two of these, or all three of these, we'll pull the trigger on them tomorrow at noon. Bingo. That was very good. I like that.
Yeah, so, okay.
Okay, tell me what's right. Tell me what's wrong.
Definitely got to slow down when you're going through the.
Well, I'm doing this for you, Kim, to speed it up. I mean, it's cool.
Right. No, I'm talking about the beginning trades. Because I think you got a good story. The question is whether we want to, on the first couple of trades that we gave them. Do we want to ask, did you make this trade? And then that's a quick poll, and particularly with the first. What's the very first ones we did? You did.
You mean the first week? I have none.
Well, no. I meant these. So we did Illumina, May 140.
You know what we should do, Dave? Just ask them to type in the stock symbol of any of the trades that they've made.
In the chat box, okay.
Yeah, that's all they have to do.
Yeah, I was trying to get some handle on how many people are actually following these trades out of the percentage of people that are in class.
Yes.
But
and speaking of which, we need to find out. We only had half the people attending last week. I think we need to find out if people are coming back to view the video.
They are. I don't have the counts, but we're getting the same number.
I'm all right. I mean, I want to make sure we're not turning people off.
No, I don't. I mean, I've got the counts for all the weeks. I don't think there's anything. I mean, we've been getting roughly the 40 in the sessions.
We had 30 last week.
30 last trading session.
I thought last week we only had 30 in the session itself.
That would have been 5. We had 40. 5. Yeah, we got 32. Okay, it was 32 in the last.
Yeah, I want to make sure we're not losing people because we could also lose subscribers and Options Income Blueprint if they don't like what's going on, and see if they're coming back.
I don't think you're going to lose these people in Options Income. Most of them are in there for a good trade.
And if they did any of these trades, they all paid for the course. I mean, these have been very aggressive. We've been very fortunate.
That's why I think you got to take it very slow when you're going through that recap because it's a good.
I did it quickly because it's going to be slow. I mean, but it's all going to be standard stuff.
We should you should take a pat on the back for the Verizon trade. The 48 in the money.
No, I can take. There's only one roll. There's only one roll here, and the 2 monthlies that we put on that people may not have wanted to put on because of monthlies are both going to have spectacular returns if they're closed out tomorrow.
Right.
So I'm happy with all of these, and I have no concerns about rate popping because their earnings are behind them. They announced their earnings 10 days ago, so I'm not afraid of a negative catalyst as long as Deepwater Horizon doesn't blow up again. And so I'll go through these slowly, and I'll use them as teaching points. I just went through them quickly because it's for you and Kim. I'll clean up the slides, and now the question is handouts. I purposely went through these 4 possible tactics in a lighter way, and the question is this. Do you want me, and you can probably say you won't have them Tuesday, you'll have them on Wednesday, I can do detailed cheat sheets for all of these.
We could do that later. I would just add, I just think maybe a slide or 2 more when you really dive into the covered combo about showing that, illuminating a little more.
Okay.
Because so when you get past is actually almost a numerical slide somewhere after, I can't remember where it was, I don't have the slides in front of me, but
what I'll do is I'll do it. 20 is the slide that says the covered combo stock, and then I'll put a couple of explanations in after that, and I'll do the same thing after double dividend, and I'll do at the end I'll do the same thing for weekly cash call, and I'll add a slide for each tactic, and I think that'll that'll be a good idea.
Now, if we have people doing Seadrill, if we end up doing Seadrill tomorrow, is there a chance we'd have a covered call or a cash call trade? Remember we talked about if we get one.
We could. It depends upon where the stock is, and people would have to own it. It would have to be a buy right, or people would have to already own it.
Yeah.
Sure. It depends upon where the stock is moving. The stock really bounced around a little bit. Well, I have to take a look, but I'm taking a look right now, but I want to see where it closed. Where did it close? It closed exactly where it was at 11 o'clock, and let's see what happened to the option premiums for May week 4. Oh wow, the puts went down significantly. That could have been a cash call trade. The 3550s. Hang on. The if you're willing to do this, you could have made $15 a contract on the puts today with the stock not moving. And $15 in 2 hours doesn't sound like a lot of money, but it actually is, because that's a 0.5% return in 2 hours, which, if you do the trade twice a week, that's a 1% return a week, which is 50% a year. So Seadrill could have been a daily cash flow. And tomorrow, if you want to emphasize that, I can throw it in as an extra stock and surprise people if I can find something in the middle of the day.
Yeah.
Okay.
I just think if somebody sees that kind of quick turnaround, then that's another further locking them into the next
well,
session.
The thing is, I want to make sure the trades work, and because they've already paid, we already have their money, and so I'm more concerned with the trades, being aggressive but conservative if that's possible at the same time. So let me take a little break, and I got a bunch of work to do, so I got to clean this up.
Okay.
We go live at 7, right?
Yeah, I mean, there's 7:30 to the session, but yeah. I'll open up at 7.
Anything else, Kim? Jay, Dave?
No.
I'm not trying to give you the buzz.
No, that's it. Go back and work on it.
Yep.
Okay.
Send me the PowerPoint when you get right before the 7 o'clock hour.
Oh, sure, absolutely. And wait a minute. Let's get back to the whole notion of cheat sheets. Do you want to make a promise that there'll be specific, like, detailed cheat sheets on each of these kinds of trades by when? A couple of days.
Yeah, you can, later this week, but I think mainly that one sheet you had there, the calculator, you're going to have a covered combo calc. If you can have that tonight, or we'll have posted by tomorrow morning at 9.
Okay.
In case we run, for next.
Well, I'll have it. What I'll do is I'll create one spreadsheet that has all 3 stocks, and they can just click on the tab, and all the information will be in there.
Okay. And then you might want to, because you can use a couple points. This is for the reason we're doing the live trading tomorrow. This is heading into a holiday weekend. Trading on Friday's gonna be light. Trading on Thursday maybe.
Oh, absolutely. That's the reason I'm doing it. I mean, you read my mind. I forgot to mention. That's exactly what.
Make sure you mention that. So, okay.
Friday is just a shitty day, and you don't want to go near it. And it's exactly the reason I want to do it tomorrow to collect more premium. It's going to be a light trading week, probably even starting on Thursday. So.
Right. Okay, we'll be back here at 7 then.
Okay.
All right.
That sounds
Thanks.
good.
Thank you.
All done.
Yep. Bye.
Bye.
Bye.